Look around your office floor right now. Look at the colleague sitting 2 desks down from you in that glass-walled office in Marina Bay or Suntec City. You both graduated from the same local university around the same time. You both hold the exact same senior managerial title. You both draw roughly the same $9,000 monthly salary, attend the same weekly regional alignment meetings, and grab the same mid-afternoon iced Americano from the lobby cafe. On paper, your financial trajectories should look virtually identical. Yet 10 or 15 years from today, something baffling is going to happen. That colleague is going to quietly hand in their resignation letter at age 52, pack up their desk with a calm smile, and walk out into a life of complete, uncompromised financial freedom, never needing to work another day for money. Meanwhile, you might find yourself staring at your spreadsheet at age 65, realizing with a cold knot in your stomach that you are still locked into your desk for another 5 to 10 years just to keep your household cash flow afloat. This is not because they won the Toto jackpot, traded speculative meme coins, or inherited a landed property in District 10. The real difference comes down to a handful of invisible, structural financial decisions made silently beneath the surface of everyday life in Singapore. If you want to understand the exact mechanics of how people quietly achieve complete financial independence on this island decades ahead of schedule, make sure to hit the subscribe button. To truly understand how this 10-year retirement gap opens up between two professionals earning identical salaries, you have to look past the surface appearances and examine the real-life choices of two people living in this exact environment. Let us look at Adrian and Kenneth. Both are 38 years old, both earn $9,000 a month, and both take home around $7,200 after their monthly employee CPF deductions. To the casual observer at an office lunch, they look indistinguishable. They wear similar clothes, work the same hours, and carry the same laptops. But beneath that surface layer of professional normality, their financial engines are operating in two completely different universes. The divergence begins the second they commute to work on Monday morning. Kenneth drives a mid-tier Continental crossover that he bought 3 years ago. When you factor in the monthly car loan installment, the astronomical certificate of entitlement amortized over 10 years, the road tax, insurance, electronic road pricing gantry charges along the CTE every morning, season parking at his office building, and weekend fuel, Kenneth is spending roughly $2,200 every single month just for the privilege of sitting in peak hour traffic. Over a 10-year cycle, once you account for interest, depreciation, and replacement costs under prevailing COE prices, Kenneth will burn through upwards of $250,000 in post-tax cash on personal transport alone. That is a massive sum of liquid wealth vanishing into thin air with zero investment return. He lives a short walk from an MRT interchange in a mature estate. On weekdays, he taps his card, reads financial journals on his 40-minute train ride, and arrives at the office completely relaxed for less than $120 a month in public transport fares. When he needs to travel with his family on weekends or rainy evenings, he books private hire rides without hesitation, spending at most $400 a month. His total transport footprint is roughly $500, leaving a massive $1,700 monthly surplus compared to Kenneth. That $1,700 is not left sitting in a bank account. Adrian redirects it automatically on the first of every month into a basket of Singapore blue-chip dividend stocks and broad market index funds. Over a 15-year period, compounding at a conservative 6% annual return, that single lifestyle difference alone accumulates into a liquid investment portfolio worth more than $500,000. While Kenneth is on his second or third depreciating car, Adrian has built an entire liquid retirement nest egg out of thin air simply by refusing to pay for status on 4 wheels. The second and far more dangerous wedge driving coworkers apart is the property upgrade trap. In Singapore, there is an unspoken cultural script that dictates your life path. You balloted for a BTO flat in your late 20s, lived through the 5-year minimum occupation period, And the moment your flat appreciated, the property agents started knocking on your door, telling you it was time to upgrade to a private condominium to build wealth. Kenneth followed that exact script. He sold his initial flat and stretched his balance sheet to purchase a $2.2 million private condominium in the rest of Central Region. To make the numbers work, he and his wife maximized their bank loan, locking themselves into a massive monthly mortgage of over $7,000. To service that enormous debt, Kenneth had to wipe out his entire CPF ordinary account balance down to the last dollar. And every single month, his mandatory CPF OA contributions are sucked directly into paying bank interest and loan principal. Furthermore, he pays $500 every month in condo maintenance fees, plus higher property taxes and utility bills. On paper, Kenneth appears wealthy because he lives behind a security guardhouse and has a swimming pool he rarely uses. In reality, Kenneth has completely paralyzed his balance sheet. He is what financial analysts call house rich and cash flow broke. Every single dollar he earns is hostage to his mortgage, leaving him with zero margin for error, zero liquid investment capacity, and an absolute panic whenever talk of corporate restructuring or layoffs ripples through his company. Adrian took a completely countercultural path. When his mature estate 5-room resale HDB flat appreciated, he looked at the math instead of listening to market hype. His flat was spacious, quiet, located 3 minutes from an MRT station, surrounded by hawker centers, wet markets, and top-tier amenities. Instead of taking on $2 million of debt to buy a private condo with half the square footage, he chose to stay put and pay down his modest HDB housing loan methodically. His monthly mortgage is less than $1,800, entirely covered by his and his wife's monthly CPF OA inflows, without requiring a single cent of out-of-pocket cash from their take-home salaries. Because Adrian's CPF OA was not drained to fund an inflated mortgage, his CPF balances remained intact, quietly compounding at the guaranteed base interest rate of 2.5% per year. But Adrian took it one step further. Knowing that his housing was permanently secured, he periodically transferred excess funds from his ordinary account into his special account in his early 30s, locking in a guaranteed, risk-free 4% compound annual growth rate backed by the Singapore government. While Kenneth was paying hundreds of thousands of dollars in commercial bank interest to finance a private condo lifestyle, Adrian was utilizing Singapore's sovereign retirement infrastructure to generate tens of thousands of dollars in risk-free compound interest every single year on autopilot. This brings us to the third secret mechanism that allows early retirees to pull ahead: the ruthless optimization of the Central Provident Fund and the Supplementary Retirement Scheme. Most corporate workers treat their CPF as a passive, annoying deduction on their payslip that they cannot touch until their golden years. The early retiree treats CPF as a precision-engineered sovereign annuity machine. By the time Adrian turns 45, his special account has already crossed the full retirement sum, entirely through compound interest, salary contributions, and strategic early cash top-ups that gave him valuable annual personal income tax reliefs. Once your retirement account foundation is secured early in life, the math of retirement in Singapore transforms completely. Adrian knows with mathematical certainty that when he reaches 65, CPF Life will provide him and his wife with a combined guaranteed lifelong monthly income of $4,000 to $5,000 under the enhanced retirement sum tier, fully indexed and backed by a AAA sovereign credit rating. Because his long-term safety floor is completely solved by the national framework, Adrian does not need to hoard millions in speculative assets just to survive his old age. He only needs to build a financial bridge that carries him from age 50 to age 65. To construct that 15-year bridge, Adrian focuses his remaining energy on the fourth pillar of early retirement: building a relentless local cash flow machine. Every single month, because Adrian has no car payments, a modest mortgage, and zero high-interest consumer debt, he saves and invests more than $3,500 of his take-home pay. He channels this money methodically into an investment portfolio tailored specifically to the Singapore economy. He accumulates high-quality Singapore real estate investment trusts that yield between 5 and 6.5%, backed by essential logistics warehouses, suburban retail malls, and high-spec industrial facilities. He adds shares of the major local banks that consistently distribute resilient dividends, alongside low-cost global equity index funds to capture international growth. By the time Adrian is 50, that liquid portfolio has grown to over $850,000, generating roughly $45,000 a year in pure, tax-free dividend income. In Singapore, dividend income and capital gains are completely free from personal income tax, making this cash flow vastly more powerful than a corporate salary that gets eroded by top-bracket income tax rates. When you combine $45,000 a year in passive dividends with a fully paid-off home, zero debt, and minimal fixed overheads, the corporate job suddenly becomes completely optional. Adrian no longer needs his company's $9,000 salary because his baseline living expenses are less than $3,000 a month. When Adrian walks into his boss's office at age 52 to tender his resignation, his coworkers in the department are completely stunned. They assume he must have received an inheritance, stumbled into a lucky business venture, or secretly made millions trading speculative markets. They cannot comprehend how someone on the same salary band can simply walk away while they are still stressing over quarterly performance reviews and worrying about whether their annual bonus will cover their children's tuition fees and their private condo maintenance bills. The reality is that retirement age in Singapore has almost nothing to do with chronological age or government retirement milestones. It is purely an equation of lifestyle overhead versus automated cash flow. Kenneth is trapped not because Singapore is inherently unlivable, but because he allowed lifestyle creep, societal pressure, and status-driven consumption to dictate his financial choices. Every time Kenneth received a salary increment or a promotion, he immediately upgraded his car, his home, his dining habits, and his holiday destinations, permanently pushing his retirement horizon another 5 years into the distance. He converted his earning power into fixed, long-term liabilities, turning his career into a high-stress treadmill he can never afford to step off. Adrian understood from his very first paycheck that the ultimate luxury in Singapore is not a luxury car badge or a private condominium access card. The ultimate luxury on this island is autonomy. It is the ability to wake up on a Tuesday morning, take a quiet walk through the park connector, sip a cup of coffee at the hawker center without checking your work email, and know with total certainty that your home is secure, your medical contingencies are insured, your retirement baseline is guaranteed, and your investment portfolio pays you while you sleep. 10 years of your life is an extraordinary amount of time. It is thousands of hours of your youth, your health, and your freedom that you can never buy back once it is gone. If you want to be the coworker who retires a decade early rather than the one left wondering where all the money went, the time to restructure your financial blueprint is not 10 years from now. It is today. Take an honest audit of your balance sheet tonight. Look at your car. Look at your housing leverage. Evaluate how you are using your CPF and ask yourself whether you are spending your prime working years buying real freedom or simply leasing temporary status. If this perspective helped clarify your own financial journey in Singapore, subscribe to the channel, drop a comment below sharing which pillar you are focusing on this year, and stay tuned for our next deep dive into mastering your money right here at home.